Hello, everybody. Chuck Carnevale here, aka Mr. Valuation, bringing you another 2-minute drill, Lessons in Valuation subscriber request series. This one is on UPS, and one of the things that you're going to see here as I go through this video is that not all price drops are the same, and I'll explain as I get into the fast graphs on UPS. The first thing I want you to note is the company's earnings growth rate over this time frame going back to 2005 has only averaged 5.2%. But it's had periods where earnings grew at pretty good rates, 20%, 11%, and 6%. This column down here is very critical to fast graphs. Then we had 2 years in the recession of '08 where we had a 15% drop in earnings and a 34% drop. You can see the earnings turned down. We're using a 15 multiple, but watch what happens when I shorten the time frame. I still get a 5.3% growth rate. If I shorten it again, I get a 4.86%. And that all those lead to a 15 multiple as fair value for the company. But here's the point I want to make. Earnings determine market price, and valuation matters a lot. Okay, so when you look at this from a long-term point of view, when UPS was overvalued back in January of '05, that led to a period of very poor performance for 2 or 3 or 4 years, or even going on 5 years in this case. And then when earnings were growing and you could buy the stock at a reasonable valuation, then your rate of return for the next several years would have been a little better at almost 11% a year. Valuation matters a lot. But the point is that all price drops are not the same. In this case, the company did get overvalued back in 2021 and beginning of 2022. And I'll just pick a time here, not the peak. But then what happened was earnings began to falter. Okay, and so the price ended up dropping rather precipitously over this time frame from January of 2022 to April here of 2025. But I want you to note that so did the earnings. Okay, the company's stock price was dropping with the earnings growth of minus 4.3%. So this is a price drop that was theoretically justified by the earnings. Now, going forward, looking at the company from today, analysts are expecting a negative year this year, which could keep pressure on the stock, but then they expect a double-digit growth rate in fiscal year 2026, and then another 8% growth in fiscal 2027. That would mean that this stock, if you bought it today, counting the dividend with almost a 7% dividend yield, you could expect over a 20% annualized rate of return. And looking at the stock from the standpoint of the dividend didn't grow very much here. But the point is they have a very consistent long-term dividend record. So at 6.82% at today's valuation may be an interesting time to be taking a look at United Parcel. Anyway, this has been Chuck Carnevale. I'll bring you another subscriber request 2-minute drill video. And by the way, 2 minutes means short video, just so it's not meant, I'm not going to try to keep it at exactly 2 minutes. But if you like the video, give me a like, ring the bell so you get notified to future ones, subscribe to our YouTube channel, and also take a look at fast graphs. What a powerful tool for the value investor to be able to analyze a company very intricately in ways that no other tool that I know of offers you. Thanks for watching.